Hello and welcome to this episode of Nothing Ventured with me, Aarish Shah. Today in the studio with me, I am really excited to have Ioto Iotov. Ioto is the founder of Mainset, an early stage venture capital firm with a focus on fintech and adjacent SaaS ventures. Originally from South Africa, Ioto has not trodden a typical path, having qualified as a chartered accountant and also been a competitive swimmer with Olympic aspirations, later earning his MBA from Columbia Business School. Ioto's career spans auditing, treasury management, and fintech operations, providing him with a unique perspective on both the operational and investment sides of business. He spun out Mainset from Capricorn Capital Partners in 2023, where he leads a team of 4 core members and 8 global venture scouts. In today's episode, we talk about learning the foundations and the language of business.
A really important skill set to have to speak ultimately the language of business.
How your relationship with a business starts at T0 but goes on for 10 years or more.
We're going to have a 10-year, potentially plus relationship with you.
For the mid to long term, there is always going to be something used as a medium of exchange, and how fintech accounts for 3% of all financial services revenue, but is growing at 15% year on year.
This idea around financial institutions have been around for a very long time as this idea of medium of exchange.
Why financial services find it hard to service SMEs and SMBs, and whether or not you should ask yourself if you're solving something for a sample size of 1.
That's the first question to be had, is am I solving this for a sample size of 1?
How Ioto found that he has built empathy with founders as an emerging manager, and how observation can get you 99%, but experience can get you to 100.
I can fully appreciate and empathize with the journey that these founders and founding teams and early employees are going through.
And Ioto's contrarian advice: everything is chemical. Let's get straight into it. Hey guys, whilst I've got you for a moment, I thought I would just introduce myself again. My name's Aarish. I am the host of Nothing Ventured, the podcast where I talk to the people behind the stories that make the venture ecosystem go round. I'm also the founder of Emerge One, a consultancy that provides fractional CFO support to venture-backed startups from seed to Series B and beyond. If you have any comments around the podcast, please don't hesitate to drop me a note on LinkedIn or Twitter. And if you really love what we're doing, give us a like, a follow, or a subscribe to show us how much you care. Right, let's get back to it. Ioto, really great to have you in the studio with me today. Thank you so much for joining.
A pleasure to be here.
Excellent. Well, we're going to dive straight in, and given your background in competing athletically, I think that was a pun I was not intending to make. But I was quite excited when I learned that you're a CA, a chartered accountant, given how often accountancy gets a bad rep in the world of venture, and especially being a CFO and running a business that fields CFOs into companies. So I'd love for you to express why you believe financial literacy is crucial for both founders as well as VCs. And what is the foundational knowledge that entrepreneurs should really acquire to effectively speak that language of business?
Okay. Well, I think they get a bad rep beyond just venture.
Yeah, sure.
Wrongfully so, I believe. Look, it's obviously as a CA and someone I think who's invested a lot in terms of learning the foundations of business. To me, it's a really important skill set to have to speak ultimately the language of business. Businesses exist and then they're expressed numerically in the form of debits and credits, which ultimately get to a set of financial statements. I understand, even moving from buyout to VC, those initial conversations, and this was pre-correction 22, 23. No one, if I brought up the idea of profitability, everyone was like, what are you talking about? Like, do you know nothing? We don't talk about profitability here. We just talk about growth. And I thought, well, that's interesting because ultimately, and it's factual that the value of an instrument is the present value of its future cash flows. And we can approximate profitability for cash flows here for ease of the conversation. And you can't escape that. Irrespective of the stage at which you invest, I get it at the early stage, right, that it's complicated in terms of determining valuation, right? But we're going to have a 10-year, potentially plus relationship with you. And our core business is buying something for X and selling it hopefully for multiples on X. And that's going to take a fair amount of time. And at the end of the day, when we're selling that business, we're not likely to be selling to another VC. We're probably going to be selling to a later stage investor and, the holy grail in terms of IPO. And the market is going to want to have a level of financial sophistication in that company. And so as a venture capitalist, I've got a much longer relationship with this business than just T0. And I think understanding ultimately how business operations translate into financials, and then how those businesses will be valued at exit is a really important thing to not to like figure out. I think for founders, we've got frameworks that we use to make our assessments about these businesses, and one of them is around competitive positioning and understanding pricing power and how that impacts your business. But ultimately around that, even when you're telling me about strategy and you're saying, look, this is my strategy, in the background, I've got the framework, which I do think is rooted in accounting, is how does that perceived strategy ultimately lead to increased cash flow?
Yeah.
Because if that strategy doesn't ultimately result in increased cash flow, that is not value accretive. I'll caveat that increased cash flow in excess of what your cost of capital is.
Yeah.
I know this is sounding pretty technical, but I think it's like going to France on holiday and not being able to speak French. You can have a perfectly good holiday, but I think if you can speak the language, you're going to have a much more enriched and probably a better understanding of the experiences you have. And I think that's the same with the basis in being a CA and investing. Look, it's a financial activity, investing. And I think personally, it's my responsibility to make sure I know as much about finance, which is part of business. And I think it's challenging to discredit that. I'm not sure I hear too much of it. It's probably more people saying that they're really boring accountants, more than that there's value to be had. But I think there is value to be had. I think for founders, look, know who you're speaking to. Not everyone thinks it's as important as what we do at Mainset. There's other ways of expressing your business activities in a numerical sense without having to know debits and credits. And then, a founder, founding teams, and not necessarily just the founding team, whose ever responsibility it is within that organization to know what unit economics are. And for purposes of the call, for purposes of this, very happy to discuss, unit economics. But at the core, it's the building blocks of your business. How much does it cost you to acquire a customer? And then how much can you generate from that customer over their lifetime? And to our mind, those are the basic units of that business. Do you have a sound business there, or business model that at scale will be profitable? And I think founders and the founding team, or who's ever responsible for having those conversations, need to be able to speak to those with a level of confidence and understanding.
Yeah, no, I would find it very hard to disagree with anything you said there, because I hold very, very similar views. And I think, we've worked with founders that have very little financial sort of know-how. And yeah, that does not mean you need to go out and, become a qualified chartered accountant, but, being able to understand the difference between GMV and revenue, or understanding what gross profit is and what contribution is, or what, EBITDA is or isn't, as well as, to your point, the unit economics, I think, is a fundamental, a fundamentally important part of building a business. Because if you don't understand how your business works numerically, right, it's very hard to scale that business and to achieve the sort of results that you're looking for, right? Because you don't have that, to your point, that framework of understanding, well, this is where we are here today, this is where we need to get to, what are the things that drive that forward? Now, you can talk about that in terms of, well, we'll add this many logos, or, we'll ramp up our marketing spend. But if you don't understand how that all interacts throughout the whole kind of P&L, balance sheet, et cetera, and especially the cash flow, you could end up burning capital needlessly, and not really achieving that growth, right?
I think it's important, maybe just as a mindset, to understand what is the ROI on the decisions you're making.
Yeah.
And you don't necessarily need to be an accountant to be able to calculate that. But it is important, I think, to really understand what is the financial impact of the decisions you're making. Because at a certain point in time, if everything goes according to plan, this business will be valued in a certain way.
Yeah.
And that valuation has a direct impact on your dilution of what you get out for all of your hard work. And I think it's a really important thing. And I think founders appreciate that. And I can definitely see the change in conversation.
Yeah.
That's happened over, a relatively short amount of time. Now, everyone talks about profitability, right? And no one wants to talk about blitzscaling, and it's all about sustainable growth. And, it is the zeitgeist at the moment. And I think founders are doing a great job in terms of saying, look, this is our path to profitability. This is how we are going to start generating free cash flow. And they're not using those exact words. But I think the market has turned, and founders have done a great job in terms of adapting to that. And I totally, no one's expressed it maybe verbally, but if I was in their shoes, I'd be like, wait a minute. 5 years ago, you were telling me like, only worry about top line. Now you're telling me about like, actually profitability is important. And which one is it? I think that story around that you never need to be profitable or don't worry about that. I think that story is hollow, because like how I started this conversation is it's fact that the value of an instrument is the present value of its cash flows.
Yeah.
And so if you're never going to generate any cash flows,
what is the point in your existence?
What is the value?
Yeah. I think the narrative, exactly as you say, has changed, and I don't think I think it's moved from growth at all costs to not just profitability, but profitable growth, right? I think that's
sustainable
growth. Sustainable growth, exactly.
The word there,
and I think that is that is an interesting concept for a lot of people that have been, building businesses, as you say, kind of, that bridged both that sort of hedonistic time within venture and the more, let's call it, mature period that we're going through at the moment. But it is possible. And look, I've always said, as someone who's run businesses for many years, ultimately, you can bootstrap a business and still have it grow and still have it build profitability. The way you have to do that is to be much more considered in the bets that you're taking, so that you're not burning capital just for the sake of it. And let's face it, I think 5 years ago, 10 years ago, whatever period you want to choose, a lot of the narrative around venture was, if you raise venture dollars, you could just throw that at marketing, see what sticks, and figure it out from there. I think what's happened now is, both because there is, there are fewer deals being done, and those deals are taking longer. Founders are being forced into forced into taking that sort of bootstrap mentality of, okay, I need to be much more considered in my decision making, such that, to your point, I'm seeing the return on any of those investments or any of those bets that I'm taking.
Yeah, I think people have said, look, it's no promise that capital will be available for the next round. It's no promise, where I think that was maybe the case.
I remember speaking to a founder. We were going through their kind of financials. I was like, okay, what's your balance sheet looking like? What's the cash flow? What's your burn runway, etc. He goes, I'm not worried about that. I said, what do you mean? He goes, I'll just go out and raise some more money.
Exactly. And I think people have said, look, maybe it's not as tough as not as easy as that. And the interesting thing is, at least our data suggests, look, while 23 and 24 were, 23 was perceivably a bad year for fundraising, it wasn't by historical norms.
Yes.
It was bad on 21 and 22, but I think the important thing to realize is those were abnormalities. At least on our data, 23 and 24 is kind of on par with previous years and the historical growth we've seen in fintech, at least, because that's the market in which we map. Founders, I think, are doing a great job in terms of thinking around, as I've mentioned before, how do we spend responsibly? But I totally get it. Like, if you raise your first pot of capital and you've been bootstrapping your business up until this point, you've been eating instant noodles and, walking to work, and you raise and you have all these dreams and hopes for this business.
Of course.
And, and it is shared by the investors, because by definition, we're long-only investors, right? We totally believe in the story and the opportunity, like the founders or the founding team. That temptation to spend must be great. And I think the important thing is to keep that in the back of your mind. How do we retain that efficient growth, and how do we keep that mindset in the business, despite the fact that we've got this additional capital.
Yeah.
And maybe this comes to the other point. Always think, what's that return on investment in terms of money out the door? The bar has increased in terms of what investors are looking for. I think that's a function of interest rates are up, and so the cost of capital has increased. I think public markets haven't opened up as hoped, and exits haven't materialized. And people were calling question marks around the distribution of capital from venture funds. And I think there's an element of risk off.
Yeah.
And you can see that at least in relation to 22 and 2021.
Yeah. Yeah. And just one final point on that, I think, that whole point around founders, in bootstrapping, raise the capital. Many founders, most founders that I've worked with have never managed anywhere near that amount of capital before in their lives, right? Like they may have been an employee in a bigger business, but they weren't sitting on multi-million-dollar budgets, right? Often this is the first time they'll have seen anywhere near that quantum of cash coming near them. And I think, it used to be the case, and I think, there are lots of stories about founders being slightly less than cautious with the use of investors' funds. But I definitely see, today with the founders that we work with as an example, there very much is that knowledge that this might be the last funding that they receive, and therefore what they do with that cash is incredibly important. Now, obviously, if the business is growing successfully, then the likelihood of being able to raise further capital is always there. But I think one of the things that I always tell anyone that I'm working with is, look, you've got to build the business as if there is no inflow coming through. Build for revenue. And then, the rest will follow.
I mean, it's a challenging thing, and I don't want to, by any means, paint all businesses with the same brush, right? Because every business has different capital needs.
Yeah.
It would be very different if you're building a capital-hungry business versus a capital-light business, and what your needs are.
Yeah, difference between a SaaS business and, say, a life sciences or deep tech business.
Exactly, right? And I'm not by any means suggesting that every single business needs to get to profitability within the same time period. Yeah. I think the spirit around how do we ultimately get there, that's an important question. And I think it's a question investors are now asking pretty early on in their process.
Yeah. What's the pathway rather than exactly when is it going to happen? Yeah.
The interesting question is, what is in the next moment of what zeitgeist again, right? Because we were always asking this question. And I think we will continue to always be asking this question. To that earlier point around, we still fundamentally believe that the value of a business is the present value of free cash flows.
Yeah, and the sad and unfortunate thing to wrap this up, I guess, for you and I is you can't do a DCF on a pre-seed seed stage business,
cannot.
Right? Yeah,
you absolutely cannot do that. But at the point of you selling that business, more likely than not, that business will be valued in that way. A lot of people say, no, it will be valued on multiples. Where do the multiples come from?
Yeah, they have to come from somewhere.
The multiples are not just magically made up. The multiples are a proxy ultimately for that. And it is fact that the public markets value stocks in that way.
Yeah, exactly. Well, look, moving on, talking a little bit about Mainset and kind of your thesis. Mainset invests predominantly in fintech, despite some of the current market challenges. So why do you believe this sector remains an attractive sector for venture investment, especially in the UK? And what do you think the future landscape of fintech will look like? And what are the trends that you're most excited about? You mentioned a couple during the quickfire. And I guess, how do we think about fintech beyond the kind of neo-challenger bank sort of paradigm that I think most people would associate with?
Aarish, you're going to have to remind me on those questions as they come along. But I think if we maybe come to the first, it was about why fintech.
Exactly. Why do you believe it still remains such a strong and attractive sector?
I think the way we think about it is we say, what are the universal truths? And maybe let me not use universal too broadly. What do we think? What do we think is going to be true for a long time? And one of the things we think is going to be true for a long time is that the economy is probably going to look much like it looks today, in the sense of people will trade with each other, business will buy and sell. People will buy from these businesses, and money or some form of medium will be the exchange of a proxy for the exchange of value. So we don't think financial services, which is the backbone of forms that the backbone on which the modern economy is built, or is going to go anywhere. And maybe not even a modern economy. You know, banks have been around, or this idea around financial institutions have been around for a very long time as this idea of medium of exchange. So we see that as a truth. The truth is that it's financial services we don't think is going anywhere. Secondly, they are very big and profitable parts of the overall economy. You know, generally it's around, let's call it 8 to 13, 14% of the overall GDP can be attributable in a developed economy, can be attributed to financial services. And then they're very big parts of listed exchanges. You know, using that as a proxy almost for what the exit market looks like for us. So we say, okay, well, they enduring businesses, we think they're going to be around for a while. At scale, they're highly profitable. And the exit opportunities for those businesses are mature and they exist. The other thing we say, okay, so that's financial services. And I use financial services and fintech interchangeably. You know, it's ultimately at maturity, fintech is a financial services business. And the other bit is why venture? Or you know, because a lot of people are saying like, okay, does that make sense? And we say, what is a universal truth there? We always think there are going to be ingenuity or ingenious people finding problems and better ways of doing it. And we think there's always going to be capital who want to back those people to do it in the pursuit of a return. And that's been around for a very long time. And we don't think that's going to go out of fashion or not be around. So if that maybe answers the opportunity, and I think maybe wrapping those two, fintech accounts for about 3% of overall financial services revenue. So it's a really small part of overall financial services revenue, but it's growing, or historically had grown at around 15%. And that number is forecast to continue to grow at a healthy clip, well in excess of overall GDP growth. So the persistence of it as an asset class, the excitement I think around it as still large profit pools available to it, and then I think your other question was around what trends or what are we excited about in the space. Like I've mentioned, those 5 verticals in which we invest. Happy to dive into any one of those, but if I think about like that earlier point around collaboration versus competition. Fintech, you know, or the idea thereof is, let's say it's 20, 25, 30 years old. And over that period of time, it's still only 3% of overall financial services revenue. And so it makes sense that in a relatively long period of time, they've only gained a relatively short amount of market share, albeit growing really fast and off a small base. It just shows you how large this market is. But there's something to be said around what is our ability to win in the space? And when I say our, I mean, what is the startups' ability to win in the space, in a space which has very large, mature, and well-funded incumbents?
Yeah, and that was going to be one of my questions, because is the disruption always within fintech seems to be coming from without rather than within?
Yes, and I think that is how you win, in the sense of I've worked in a very large bank before. You know, to get my Windows login changed, I had to phone 3 different call centers, you know, get 4 different forms changed.
Well, there are 30 legacy systems all trying to talk to each other badly.
Exactly. I mean, I did quite a bit of work for this bank in terms of how it generated its margin, and even that, and you could never switch a legacy system off because you're too worried about that the new system wouldn't reconcile, and so you'd run these in. And that tells you about how difficult it is to innovate in it. And I think the idea around outsourcing innovation to a more nimble startup is a great path to prosperity for both the incumbent and for the startup.
Especially within financial services, I would say, because they have all of this legacy, kind of 100 years worth of outdated, outmoded systems, etc. But equally, and I remember talking to the...
And 100 years is young for some of them, right?
Exactly, you know? Right? Yeah, I keep forgetting we're in 2025. But like, you know, I remember talking to someone who's sort of the head of innovation within a fairly substantial bank from the Netherlands. And he got so frustrated because, you know, he would present an opportunity for something innovative to be built within the bank, let's say. But there would be two sort of divisions that sat side by side but weren't allowed to talk to each other, and hence there was an absolute inability to get anything off the ground because you just couldn't get the.
I think if you're going to do that successfully in a large financial services, it's got to be its own persona.
Yes,
it's got to be separate premises. It's got to be a separate name. It's got to be a separate team. That decision making you can't apply the same decision making of an organization that's been around for 300 years and wants to continue being around for that long to a business that's been around for 300 days. It is just a different risk mindset to do it. And I think those who have done it well have acknowledged that and just said, look, that's going to be something separate and we will reap the benefits of whatever it produces, but we acknowledge that there is an element of risk there.
Yeah. The interesting thing is I was recently, in fact, yesterday talking to someone from one of the very well-known UK banks, and, you know, they were talking about the likely product offering that they're going to be launching for sort of earlier stage businesses over the course of the next, 6 months onwards. And what was really interesting to me was I was going, you know what, there's been like a half a dozen new treasury management tools come onto the market over the last couple of years, right? All sort of, aggregating and creating ability for businesses with smaller balance sheets to invest or at least, utilize their capital a bit more effectively, right?
I mean, those businesses could not exist before when interest rates were zero, right?
Correct, right? So, they absolutely didn't, right? But, these are money market funds, T-bills, etc., right? But the thing that struck me was that actually when I thought about my interactions with all the various banks, beyond FX services and maybe a CD or an interest bearing sort of deposit of some nature, they didn't really offer particularly sophisticated instruments along those lines. And it just sort of struck me as that's crazy that I can't go to my bank and find a relatively cheap in terms of kind of cost to me and effective in terms of amount of capital that I can put in. Because, okay, even some of these fintechs.
And you're talking from a business point of view?
Yeah, from a business point of view, right? Like I was sitting there going, well, I
think that is one of the thematics in terms of the retreat of banks from servicing the SME or SMB.
Yeah, they find it too hard. Right?
It's really challenging, right? Yeah. And you've got an infrastructure that is 300 years old and 6 legacy systems. Those don't come for free. And I think you've seen it in the lending space as well. A retreat from lending to SMEs and SMBs. And those are really essential. As you know, they are the majority of employers in most economies. And so there is a real opportunity set there in terms of as those established players move away, there is space available to service those customers who are smaller value customers, but you can service them without the technology debt and associated cost that some of the larger players have. And I think there are people who are doing that successfully.
Yeah, I actually, just as you were saying that, the other thing that came to my mind was, you talked about one of the thematic verticals that you look at Mainset is sort of office of the CFO. And I try to build in that space myself. And I know a number of businesses that have been trying to build in that space. And there's been a few that have exited over the last sort of 6 months, to quite a lot of press in some cases, some of them more transactional rather than kind of what I would call the strategic side of it. But one of the things that I found when I tried to build, and ultimately the reason that I stopped building was I was trying to attack the SME space. And what I found was that it was so fragmented and the CFO offering is so broad that actually it was very hard. I mean, unless you verticalize quite significantly and niche down, I think it was quite hard. It would have been quite hard to capture market share. In fact, my knowledge of some of these other businesses would suggest exactly that. Despite tens of millions raised, they're sitting on sub 1,000 customers, and it was just very, very hard to acquire and retain those sort of businesses. So I'd be interested to get your take, kind of briefly on that and how you see that happening. With that said, I spoke to on Monday a business that is, has created, and again, it's another layer on top of AI, fine, but something that looks like it actually could be quite good for FP&A and variance analysis, specific for SMEs. So I think that shift may well be happening with the emergence of AI and agentic AI. But yeah, it'd be interesting to get your take on that.
I think it is a challenge to scale some of those businesses, right? And behind that, you have to ask yourself the question, if it's difficult to scale, is there a real problem that exists?
Exactly, yeah.
And maybe that's the first question to be had, is is, am I solving this for a sample size of one? And that is a sample size because I've experienced that pain point.
Yeah.
Right. And you've got it. And look, everyone enters and starts to think of business with the best intentions, right? I don't think there's potentially some bad actors, but on the whole, everyone's, they really fundamentally believe in it. They're giving their time, they're giving their energy, they're putting often their life savings and their family's life saving into it. But it is important to remember that all of our experiences are sample sizes of one.
Yes.
And it is, even with building Mainset, it was a series of yes/no decision points. Can we get to that next decision point? And ultimately, first, you almost have to say to yourself, is there a problem to be solved in that space? And coming to your point, if you're running into a point where you can only get to 300 or 400 customers, and that's kind of where it taps out, I do wonder around maybe not solving how do you get to more. It's what brings to mind initially is there a real problem in this space that needs solving?
Yeah. And often that problem is framed just before we get on to kind of the next point, because I think something you said there is quite pertinent. But often that problem that people are trying to solve in that space is, can I build a better Excel? And I think my answer to that question is always, there is a reason that Excel or Google Sheets or spreadsheets work so well, especially within SMEs.
I hear you there, but I think the question more is, who's asking for better
and
Excel?
Who's asking for it? Yeah,
right?
Exactly.
And I think people are saying, look, like, it's frustrating and I wish I could do more in it.
But it costs me nothing. I know how to use it.
And everyone else knows really how to use it, and I can share it. And I think until you can get that hook in terms of like selling that product, and I think there was talk about Excel killers. I think it's challenging, especially around who are you eventually selling to, and people have built their careers on being macro kings.
Yeah.
And selling them a tool effectively, and you're probably selling into the CFO at that point in time. It's a really challenging proposition to say to someone, by the way, I'd love to sell you something new, which you know nothing about, and would probably take away a lot of your perceived knowledge strength in the tool that you're currently using. It's really challenging. And I think people are now starting to think, how do we build tools in collaboration with us, right?
Yeah. How do they sit as layers
particularly
on top
in the FP&A space?
Yeah, exactly that. No, I couldn't agree more. And I mean, I just like as a parting kind of point there, again, talking about large corporations, financial services, etc. There is a reason that in any business of any size, you are always going to find Excel sheets running around the whole organization. They are kind of part of the language of business operations.
And Aarish, just thinking about that, maybe a question I know this is particular to one sub-vertical, but as you're selling to these SMEs, at some point, they're also very well served by the ERP systems, which they grow up into. And so coming back to this earlier conversation around customer lifetime value or unit economics, it is challenging as a business where you can't almost capture the full life cycle of the customer.
You're gonna churn them at some point.
And the question you may ask is, how do we grow with our customer base? And I think this is not necessarily just for this subvertical. This might be for business in general. If to get to a venture backable business, and not all businesses need VC, right? There's alternative ways we've mentioned them, Bootstrap, and if I want to have that kind of outcome, and venture capital backs around, this is specific to the US, around 1% of businesses, I think, ultimately are VC backed. Or the stat could be even lower. But around 60% of listed businesses have had some form of venture backing. So they do grow generally into outsized businesses. And so if you are looking for it, it is a very credible avenue. But you've got to just say, like, okay, is my market big enough that I'm serving, right? And if it's not, then just think of alternative ways of growing that business or finding finance elsewhere.
Yeah. No, look, 100%. And it's something I talk about all the time, right? Which is that not all businesses are or should be or need to be venture backed. And I think founders often do not think about some of the consequences of taking VC funding and what it means for their business, their chance of success, and also their life and their lifestyle, right? And I think that message that you don't need VC funding to be. I mean, I always think about it from this perspective, right? If my business were to grow sufficiently enough that it could exit for £5 million, I own 100% of my business.
Mm-hmm.
That's not a bad outcome for me. I'd be pretty happy sitting at 46 years I mean, it might happen in a few years' time. Who knows? May never happen. But the point is, it's much easier to get to that smaller outcome, which is still substantial, than it is, betting on the huge outcome, which we're also seeing, obviously, with liquidity preferences and the preference stack kind of building up. You could exit your business for $500 million and walk away with meager to nothing in your own pocket. But I wanted to.
Obviously, you could also, you could make a life change.
Of course, 100%. Right?
I think the important thing there is, just like I said earlier, in terms of not painting everyone with the same brush, not every sponsor is the same in the way they think around partnerships, and that's really important to us, right?
Yeah.
We have one life, and doing well by each other is really important to us, particularly at Mainset. And we want to enjoy the process and the journey with you. And yes, we're financial sponsors, and we need to return capital to our investors. But life is also too short to go into business where there's no joy.
Yeah.
And there's no joy in that process. And, we are wanting that to be a joyful experience for both sides.
Yeah.
And I suppose it's like a marriage. It's much healthier and much happier if it's a good one.
Yeah, no, look, I hear that sentiment. And by no means am I saying, no one should ever take venture. I think venture is an incredible mechanism for businesses that have the ability to or the potential,
totally,
the potential, the possibility to get to those outcomes.
I think the point you make is pertinent in certain terms of understand what the expectations are.
Yeah.
I mean, I've had advice from some other venture capitalists is don't ever talk about an exit when you start that meeting with the founder or founding team. And I think that's, to my mind, bad advice and something we definitely don't practice. It's an adult conversation, and people need to understand each other's businesses.
What are the position where we're starting from? Yeah,
this is our business, is to buy and sell stakes in businesses, and we have to very carefully think about how we exit that business at the appropriate time, with the appropriate process. It's not, it's not pulling, bringing a surprise or leaving anyone in the lurch. But I think it's a misplaced conversation not to have that at time zero. And people accepting venture capital money should also know that expectation from their partners. Like any relationship, right? To say, like, let's be transparent and like, what is it that we're hoping to get out of it?
What is a common objective? That
exactly. And we're completely aligned in that sense. And we have that conversation. And I think avoiding that conversation, I'm not saying that's the exact reason why there's an issue around DPI, but maybe that's systemic around like not thinking about like, okay, well, why do we exist? And we're quite clear in terms of why we exist. We've got two customers. We've got our investors who we need to return capital, and we've got our founders who we need to support with expertise and capital.
Yeah. I think one kind of final point on that is I remember talking to an angel investor and, one of the things they said was, the minute you take cash from any investor, the time is ticking on an exit, whatever that exit might look like. But no one invests in a business. I mean, okay, you may have some philanthropic investors, let's say, but no one invests capital into a business as a shareholder for a return, absent the return, right? Like the return is the sine qua non. Without that, there's no reason to invest.
I mean, and the time is literally ticking because IRR is time sensitive.
Correct. Yeah.
Not everyone measures returns in IRR, but the fact is, time is not your friend.
Yeah, absolutely. Well, I wanted to move on, and you touched on this as well, right? So you and I have spoken about how building a firm as an emerging manager is not unlike launching your own startup, right? How do you think about that sort of dual responsibility of being both an emerging VC as well as the founder of Mainset? And does this kind of color or impact your investment decisions? And do you think it's kind of influence your empathy towards founders?
One, absolutely it has.
Yeah.
If I compare myself I've always been involved in forms of entrepreneurship at a small scale. Like I said, mentioned selling sweets at a young age. That was, my first foray into it. But this is something quite different. And I can fully appreciate and empathize with the journey that these founders and founding teams and early employees are going through. And it comes back to that sentiment around good actors. And really sitting there, because things are not going to go according to plan. Fact, like you're going to get that business forecast and it's not going to happen, and something, unexpected, and a macro event will happen that no one could have thought about. And knowing the fact that these individuals have made huge sacrifices to do what they're doing is a very important thing to keep in mind. And to have that level of understanding and empathy around these people are giving it a good shot, or really are giving it a good shot. And if we didn't think they were capable of that or doing it, we should not have invested at time zero. And so if anyone needs to point fingers at underperformance, it would be pointing fingers at ourselves. So a level of understanding, and really, the living and breathing, and the highs and lows of entrepreneurship. I know with swimming or racing, you could live a lifetime in a minute, right? You have these extreme highs and the extreme lows, and I always thought that was quite powerful because it teaches you almost self-regulation in terms of like, okay, I know it will be better in half an hour when I put everything in context. But there is a level of empathy. I think someone who has built a business themselves can. I think not. It's an interesting idea around if observation can get you 99%, experience can get you 100%, but that might be a non-linear graph. And how big is that gap between 99 and 100%? So absolutely, I think it gives an element of credibility as well.
I don't disagree at all. I think this question, and I think this question surfaces often in the wrong way, which is, do you think operators can be better VCs or better investors? And, there's all sorts of kind of talk around that, and the fact that 62% or whatever the number is now of US investors are ex-operators from a VC perspective, whereas in Europe you only have about 6%. Okay, that's fine. But operating a business versus investing in a business are actually two fundamentally very different activities. And yes, of course, you need to have an understanding of how a business operates, but that is different from the decision-making process as an investor.
Yeah, I think it's an interesting idea there in terms of, and I know the data is mixed in terms of which makes the better investor, operator versus corporate financier, non-operator. Look, going to public markets and not saying public markets are the same as private markets, I don't think anyone's having a conversation, are you a good investor because you weren't an operator?
Yeah, exactly.
Are you a good investor because you've generated returns for your investors? And I think that should really be the question, is around like, what is our business? Our business is to grow, help grow businesses and then ultimately return capital to our investors. Can it only but help? Understanding? Absolutely. Yeah. And, we didn't touch on this earlier, but I'm South African, as I'm sure you can tell, and I did my CA there, and you spend 3 years in articles, and that really gives you an understanding of various businesses from a very early stage in your career. At your early 20s, you're sitting with CEOs of listed businesses, understanding the operations, understanding the strategy, and that gives you a sense of how these businesses actually work.
And that comes back to kind of the language of business.
Totally. And earlier, even in Mainset, the fact that we only invest in those 5 verticals, it's because we have experience either within the group, and Mainset is part of a much larger group, or in the team, deep experience in that. And we can understand what that business is doing. It's not an abstract idea to us.
Yeah.
And I think that's important for us.
Yeah. I don't disagree with anything you've just said. I think that debate about operator versus investor is, as I say, a bit of a red herring. But I think fundamentally understanding how businesses operate, especially at the venture stage, where you may have to some extent, complement some of the gaps that founders may have and provide your insight and expertise. Of course, there are investors that are nothing but the capital, and that's also equally fine. But if you are a VC that is able to support, help, coach and give benefit to the founders that you're working with, then that's only going to hopefully lead to a positive outcome for both sides. I wanted to move on just before we kind of close off the pod, because I know this is a topic that you are you are quite passionate about, maybe. So, VC feels like quite a privileged industry to many, right? So how do you think socioeconomic backgrounds impact one's ability to break into VC? And beyond this, what steps can the venture industry take to improve diversity at the GP level, particularly in terms of kind of gender and sexual orientation? We see a lot of talk and noise about backing more diverse founders, which is appropriate and correct. And we know that, less than 2% of VC funding goes to females, but actually of that 2%,
which is in the decline.
Yeah, which is on the decline and has been for the last couple of years. But of that 2%, only sort of 0.6% goes to diverse founders, right? So, but we don't necessarily talk about it as much at the VC, at the investor level. So I'd love to get your thoughts on that.
So, okay. So I think there's two questions in that. The first one around breaking into maybe any lucrative profession with how do you overcome privilege or lack of privilege? And then the second question was around diversity at the GP, and then got it. One bit of advice someone gave me in terms of when I was thinking about like investing and going into it, they said, well, what you could do is you could write a couple of, you could write checks into businesses and get experience. And I thought, well, that would be great.
If I had the money.
If I had the money.
Yeah.
And if that is a criteria or one of the credibly suggested paths to getting into a profession that you have to
sort of track record,
be able to commit 50,000 to 100,000 pounds to build that, that's a really high bar for the majority of people to get over. The way I've gone about it, and coming from not a lot of little to no family means, is I've always found that every time it was a bit of like every time I got a qualification, I got a better job and I got paid a bit more money. And so I was like, okay, well, that's a bit of a formula. And let me take that approach to it. And I think there's many ways to skin a cat. Perhaps before even answering that question, you might say to yourself, is it harder not having means to do things? Yeah, it is. I think that's probably not a secret, right? And so like anything, like a founder who has limited cash, you've got to find ingenious ways of skinning that cat, or cracking that nut. And it's interesting. I think, when you think about also great art often comes from periods of non-stable times because people are creative and finding new ways of expressing, and I think that's the same thing. And I would not give anyone any advice based on my sample size of one.
Of course,
but that's the way I had gone about it, and it is a big personal sacrifice. I went to business school and I self-funded that, and I was very fortunate to get a couple of scholarships along the way. But that is a massive personal investment, both financially and in time. And you've got to figure out how do you think, what is the path that you could credibly, or that you could take that works for you given where you come from, knowing that the odds are probably, it's not a fair world, and I think everyone knows that, right? And that's coming maybe to the second question. I love it if we get a founder who is non-normative in terms of white and male, because I just know how much harder they most likely had to work to be in that same position. And I'm not pointing fingers at anyone. And I know it's not fashionable at the moment to talk about these kind of things. But if we're in the business of backing tenacious individuals and teams who can break through walls and who can find clever ways of growing their businesses and who are driven and resilient, by all means, these are the individuals then who have already shown that tenacity just to get to the same point.
Yeah. They started.
Have you come from a different country?
Yeah.
Are you of a certain sexual orientation? Are you a gender, race, religion, depending on where you are? These are, if you've been able to get to the same point as everyone else who's potentially given, there's this idea around homophilia, and we are with people who look like us.
Yeah.
And the research has shown in venture, and a lot of that has been focused actually on gender, and more so than on, let's say, sexual orientation. But there is a tendency for people to back people who look like themselves. You know, even this idea around the airport test.
Yeah.
Would you like to hang out with that person? Generally like to hang out with people who you like to hang out with, who often look like you. And it always blows my mind. I think if someone says, and they claim that on their website, like, we only invest in people who are brought to us through our network. I'm like, but your network probably looks like you, which by virtue of that fact, you only probably invest in businesses or people who look like you. Aarish, it is challenging in terms of the stats you say, in terms of women or minorities as well, which is even worse. And the interesting thing is, though, when you look at the admission, or maybe not even admission, the graduation rates of females and minorities into degrees, which are proxies for entrepreneurship, so let's call them STEM degrees, or venture, let's call it an MBA, those rates have become now parity generally with the wider population. The interesting question is, why aren't we seeing that on the entrepreneur side? And then why aren't we seeing that at the allocator side of the VC side?
I was just going to say, I mean, that is the question, right? And the way I always think about it is, in order to promulgate or propagate more diversity at whatever level throughout the ecosystem, you need diverse LPs funding diverse GPs, funding diverse founders, building diverse teams, who then have substantial consequential exits and are able to recycle.
I think the important question, though, is to say, because some people say, well, you know, is it diversity for diversity's sake? I mean, just from a VC point of view, it has been found. I think it's Gomfers and Wang out of HBS who have put out quite a bit of research on this, and they found that GPs which have more female partners have outsized performance in terms of IRR. I don't want to butcher the number, but it's a material IRR uplift. And so, to my mind, there is the perfect case around diversity leading to actual business outcomes, not diversity necessarily just because it's a thing. I think the other thing to remember is that in of itself the worst thing in the world, because we don't all start at the same point on the starting grid, right? And this idea around it's a complete meritocracy, I hear you. But like that's drawing a line, you know, not at the beginning of the race. That's drawing a line at the end of the race. And, you know, some people had to run 130 meters and some only ran 90, you know, and, you know, I'm not a runner, but I would imagine your chances are better if you ran shorter.
I think I would probably agree with that. I mean, I think the way I think about it, you know, beyond sort of that relatively sort of high level kind of view of recycling that capital with diversity, I think, you know, someone on the podcast said, you know, diversity is being invited to the party, inclusion is being asked to dance, right? And I think the point is always, how do we make sure that everyone has the opportunity to apply?
Totally.
Right? Not necessarily that means that they will therefore have the opportunity to win the job or raise the funding or whatever. But if we can get to a place where everyone, regardless of where they are, where they started from, etc., has the exact same opportunity to walk, you know, to knock on the door and say, hey, give me a shot. Yeah. Thereafter, the decision is what the decision is. But I think the problem we face at the moment is, you know, talking to lots of female founders, often female founders and others from minority backgrounds, what I tend to find is that they are, you know, I mean, for a start, they are tenacious. They are really, really kind of hungry people, but they also carry this level of almost self-doubt that suggests that, well, I won't go to that top tier VC because I'm not quite there yet. My numbers don't show, you know, the right traction or whatever it is. Whereas I think, and there is research on this, which I haven't got to hand, but you know, so female founders are much more likely not to kind of bullshit their way through versus a male founder who will kind of say, yeah, it's fine. We'll, you know, this is where we're at.
Maybe we can ask ourselves the question is, why does it matter? And here's the thing. Here's why I think it matters. And you talk about the LPs, right? The LPs to the GPs, and for listeners, those are the LPs, are the limited partners. They're the endowments or the pension funds.
They're the investors.
They're the investors in the GP. The GP being the venture capital, venture capitalist, and they're the purse strings ultimately, but their capital base generally is from quite a diverse. If you imagine from insurance businesses, that's a pretty diverse group of individuals who are paying their premiums, and so you have this very diverse base from which you're collecting, which then gets concentrated into a group of individuals who then allocate to a group of individuals who are non-representative, who then go on to found businesses who are non-representative. And here's where it gets important. Here's where those businesses grow into they have outsized venture-backed businesses generally grow into much larger businesses than non-venture-backed businesses. Yeah. And why does that matter? Because those businesses go on to pay tax. Those businesses go on to employ people. Those businesses go on to have a societal impact, right? And so if we're saying, look, we actually have a responsibility in terms of thinking about what kind of society are we ultimately building through the decisions we're making in who we invest in. And our doors are open, and we love individuals who are non-representative maybe of what the status quo looks like, and whatever that status quo is, because if that status quo changes, then let's get people who don't look like, because we do believe that you've actually, to this point, there's data to us that look how tenacious and driven you've overcome potentially more obstacles than others. And you've gotten to this point, we should have a serious look and consider backing you, because we do think in this instance, past behavior is a predictor for future behavior.
Yeah, I think that's a wonderful sentiment and a wonderful approach. As we wrap up, I have one final question for you. What is one thing that you have a contrarian opinion about from any area of life, whether that's work, politics, socially, or at home?
Maybe I won't express that because it probably would age badly. It's something I'm thinking about at the moment. We've been thinking about for the last couple of years is just the idea around where it stems from is to say, pat on the back, you did a good job there because you were tenacious or you were driven. And then I was like, well, was that you? Or did you have any way in doing that? Because why do some people, when they were faced with similar circumstances, had maybe a less than positive reaction to it and maybe crumbled and then it got me thinking about this idea of self-determinism and decision-making. And I was listening to someone speak around the chemistry of decisions, and ultimately at its most basic 0-1 level, everything is chemical. And ultimately, and if everything is chemical, that means and my chemistry was set at time of when chemistry is set, what control do I have around those decisions that I perceive because a lot of everything is luck, right? Where you were born, what skills you were born with, at the time where those skills are either valued or not valued.
What family were you born into?
What family? All of that is, what gender when that gender is favored, what race when that race is favored. Those are big macro things which ultimately determine your current success in life. Not all, those you had no control over, but those that you seem to have locus over, I'm questioning, do you have any of that?
Yeah.
And then that brings you into this whole world around self-determinism versus free will or agency. And I guess the one takeaway is don't be too self-congratulatory and be grateful for everything, because a lot of the times it's sheer pure luck.
I think, again, a wonderful sentiment to end the podcast on. Ioto, for the audience, where can they find you online? Are you on LinkedIn, Twitter? Where is the best place to find you?
LinkedIn, and then they can visit our website. We invest into businesses, like I say, in multiple geographies. It's all laid out on our website. It's mainset.co.uk. We would love to hear from you. There's a page where you can fill in your details and reach out to us. We'd absolutely love to hear from you.
Amazing. Well, we'll drop the links into the show notes for the time being. Thank you so much for joining me. I really appreciate it.
Absolute pleasure. Thanks, Aarish.